All right, everybody. My name is Oliver, and welcome back to another episode of Footsteps. On today's episode, we got some quite interesting topics. I'm going to be talking about the efficient market hypothesis and various other things relating to efficient markets and why sometimes these hypotheses might fail or why they might be true. And I'll be giving some of my own thoughts on why I think that the efficient market hypothesis has some value. So let's get started. So I was recently inspired by a YouTube video that I was watching the other day by Patrick Boyle. He's a quantitative investor who runs his own hedge fund out of the United Kingdom. And he was doing an interview with someone who creates these books called Unknown Market Wizards, called Jack Shwager. And during the interview, they spoke a lot about the efficient market hypothesis, and I found it very interesting. So I decided to give my own 2 cents on this thing and about what they were talking about. If you want to see this video for yourself, be sure to check out the description of the video or my YouTube podcast. And yeah, take a look at it. It was very interesting. They talked about a lot of stuff and they went above and beyond just the efficient market hypothesis. So definitely go check that out. So before I begin kind of relaying my thoughts, I should probably explain to you what the efficient market hypothesis is. So in effect, the efficient market hypothesis says that there is no way for someone to get an edge in the market because the market will always instantaneously adjust for any and all available information. According to Investopedia, the theory states that stocks always trade for their fair market value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks at inflated prices. So this is essentially saying that if markets are indeed efficient, they will be able to adjust for all of the available information, and the prices in the market will always reflect all of the available information to the investor, and nobody has a different set of information than anybody else in the market. And I'm sure that if you've been around long enough, you realize that this isn't always true, but in theory, there is some use to this efficient market hypothesis. According to a paper from the University of Central London, many different economists and researchers throughout the 1900s realized that movement of stocks can be related to many different things. One of these relations was Brownian motion, which is the random movement of particles in a liquid or gas medium. So essentially, the stock market here is compared to random movement, and similarly, another guy compared it to the chance curve of rolling dice. Another guy in the 1930s, Alfred Cowles, after analyzing the performance of investment professionals, came to the conclusion that stock market forecasters cannot forecast. So there are so many instances of these kinds of things, and these price movements that are random would essentially disprove the efficient market hypothesis, because if people had the same available information, there would be absolutely no reason for somebody to be trading at a different time than anyone else on a different set of information than anyone else. And as the years went on, there was a guy, Mr. Ball, not sure what his first name is, but in 1978, he said that a market is efficient with respect to an information set T if it is impossible to make a profit off this information set. So he is essentially saying that the efficient market hypothesis is false, but you can word it in such a way where if everybody has only a particular set of information and nobody is making a profit off of that information, or an outsized economic profit off of that information, then the efficient market hypothesis would be true. However, he just basically proved, just by that one simple statement, very eloquently put it, that it's false. So yeah, there have been many periods throughout history where if you choose a particular strategy, such as trading immediately after a positive earnings event in the 70s, you would consistently beat the market. Or if you invested in tech in the 1990s and sold before the crash of 2000, you would have made a significant amount of money. There are so many inconsistencies in the market, and they all essentially prove that the efficient market hypothesis is false. I'm sure that if you've spent any time in the market, you realize intrinsically that it does not act in a rational manner, and it can be argued that the efficient market hypothesis is in fact impossible because investors are emotional and do not trade rationally. So, what's the point of this hypothesis if so many people are trying to disprove it? Well, in some senses, because there are some inconsistencies in the market, it takes a very particular kind of person to be able to capitalize on these inconsistencies. And sometimes they can be so small that the amount that you pay in commission to try and take advantage of these inconsistencies can actually like counteract the amount of money that you would make from like trying to take advantage of them. So if you spent any amount of time in the market, and if the efficient market hypothesis was true, that means that no matter how long you spent studying the market, you would never be able to outperform the average index fund. And you would be better off to not waste your time trying, because you would see no results. And that is kind of where the utility of the efficient market hypothesis comes in. Because for most people, this theory holds a lot of weight. And if you're not part of that 1% of people who has the time and the resources and the brains and the capital to try and take advantage of inconsistencies in the market, then you are most likely just going to end up wasting your time trying to find a small token of information or analyze a very particular kind of pattern. You might not have the right statistical knowledge. You might not have the right like emotional knowledge, and you might not really understand economics the right way. And your time would likely be better off spent just investing in an index fund and letting your money sit there rather than trying to spend every minute of your day to get a higher return on the market. There are people out there who can do it, but as I said, for the majority of people, even people that are like pretty good at stock picking and things like that, most of the time, 99% of the time, it's better for those types of people, for most types of people, to just take their lower risk and not spend too much time thinking about their investments and just throw it into an index fund and wait for 30 years. And yeah, I have my own story about how I thought that I could beat the market and how it almost worked out. But it turns out that things like that in some way was essentially just like gambling. Like you were kind of just throwing money at a company that didn't have any validity. It was like penny stocks, right? All of these companies are essentially shell companies, and you basically just see these CEOs paying themselves like $400,000 salaries, and their companies are making zero money, and they have no future prospects of making any money. So you're essentially just paying some CEO salary by investing in these companies. Well, investing, you don't invest in penny stocks, you trade them. So, and the only way that you would make money off a penny stock is if enough people are irrational and think that it's going to go up just like you do, and you manage to get in before the majority and out before the majority. And that's kind of how like penny stock trading works in general. And oftentimes it's easier to figure out how to make money on the way down than it is on the way up, because usually it's easy to see an irrationally traded stock that just continues to climb and figure that at some point this is going to crash. However, in the main market where you have the bigger companies, sometimes they just keep going up. And I'll get into a good example of that really soon that I'm sure you have all been paying attention to this year, because you can't have not heard of what's going on. The point of this like penny stock trading stuff that I was doing was to try and get a return that was out like over the average market return, because I didn't have a lot of money, and in theory I still don't, but I was just trying to get like a quick return on my investment because, I was young. I wanted to like double my money just like everyone else who first starts out trading. And at one point, actually, I did have a unrealized return of 100%. So I did double my money, but I was part of that group of people who didn't know how to press the sell button. So I just watched it go all the way up, doubled my money, and watched it go all the way back down and negative. And then I ended up losing money. It's like any field out there, you can't expect to be good. And I was like in high school when I was doing this, and I didn't I didn't have any education. I was not like the smartest out there. I was very emotional in my trading. There were so many things that I was doing wrong that you shouldn't be doing if you're going to be taking this trading stuff seriously. But at the time, I didn't know any of this. And yeah, there was one part in the interview that Patrick Boyle did with Jack Shwager that they said it's like any other field. There's only going to be an extremely small group of people who are outstanding traders. So it's like in music or in any other type of like performing arts, movies. There's always going to be that really small group of people who is just outstanding at what they do and who make the most money through like these types of things. So in some cases you can be very good, maybe even good enough to beat the market from time to time, but 99% of the people, but for 99% of people, the efficient market hypothesis is essentially true and they should probably act like it is. So now I'm going to try and analyze some companies that seem to be trading in a strange way and see if the efficient market hypothesis can explain it or if the theory falls short and we'll need a different theory. So obviously here I have to talk about Tesla. So this past year, Tesla has gone crazy through the moon. And it's been a ridiculous thing to watch. And if you guys haven't been following Tesla's stock price, this past year has at least increased like tenfold. It's been absolutely ridiculous. And the net profit of Tesla, I think they had their first 3 profitable quarters this year, or maybe their first like 4 if you count part of 2019, which is ridiculous. And its market capitalization is somewhere in the $650 billion range, which is just about the same amount as Facebook was not so long ago. And it just doesn't make any sense whatsoever for this stock to be trading so high. And from my observations, when I was watching this happen, Tesla just seems to be trading like a penny stock. And I would venture to guess the odds of a crash are very high. But as the famous saying goes, don't bet against Daddy Elon. Man, you really got to be careful out here. So based on the information that is available for the Tesla stock, there is absolutely no reason for it to be trading as high as it is. Its price earnings ratio is like 2,000, which means it's trading at a 2,000 times premium to how much money it's making. Of course, there are arguments out there that say you can't value a company like Tesla based off its price earnings ratio. That's fair. Okay. Even if you can't, that's still an absolutely ridiculous number. There are so many indicators for Tesla that like it's completely irrational that make it make 0 sense. And if the efficient market hypothesis was true, I don't think that you would see a company like Tesla going as high as it has been going. There's a different saying out there, which like if you were to short Tesla right now, it's very possible that the market will stay irrational longer than you will stay solvent. And this saying, I think, kind of comes from the 2008 housing crisis. I think I heard it from like The Big Short or something like that. But essentially, you take a short position, and if a stock continues to move higher and higher and higher, you will run out of money fast, and you have to pay your borrowing fees and all of that. And in theory, a price can move to infinity on the way up, And if you're holding a short position, at some point you'll have to liquidate your position to be able to pay it down. But if you bet that a stock is going to go up, the most that you can lose is like all of your money, not more than what you have. Like the stock price can only move to zero. Meanwhile, on the way up, it can move to infinity, which is why betting against a short is, or betting that a stock is going to go down in a short position is kind of a dangerous play sometimes. But yeah, if you think about a company like Tesla, what do they have to offer? So they have their self-driving stuff. They have really great cars. They have they have a lot of stuff out there that is good. In some ways, you can think of their valuation kind of as similar to a valuation of a tech company. Tech companies tend to not trade for what their like assets are worth or based on like how much money they're making, and they tend to trade for a much higher premium on earnings than other companies do, because the thought process is that in the future they will be able to make a lot more money, and these earnings now, the price that it's trading at now, will be justified in the future when they start to make a lot more money. And I think people are kind of doing the same thing for the Tesla stock right now, that they have so much future hope and future potential for Tesla that it would honestly, at this point, be hard for them to fail, because they've raised billions of dollars of money through the markets. They have expanded into China. They're going to be expanding into Berlin. They have figured out their production for their reasonably high volume vehicles. And there's just, people love their cars. It's hard. It would be really difficult for Tesla to screw it up. And I think that maybe the majority of the consensus out there is exactly that there's no way this company could ever possibly fail. So it's trading at like a 15-year in the future price tag. And people think that, it'll be worth like this much money and, whatever, how many years from now. But I think that another motivator here is that Tesla stock is just being traded irrationally. Like, who's going to be the biggest idiot, right? Someone has to buy at the top, and then a stock is going to drop, and they're going to be stuck holding the stock at like whatever price it ends up at, like $1,000 a share now. There's so much hype around the stock that there's nothing that can happen to make it go down. And people are always just going to keep betting and betting and betting and betting on it until people start to lose their faith and they start to believe that the stock is too high. But even then, the momentum that has carried them so far can continue to keep them at a certain price. There's a lot of interesting theories behind why stocks trade irrationally, just like Tesla is. Kind of related to the Tesla stock, as you guys know, in 2020, coronavirus pandemic still ongoing, but the entire stock market at the start of the pandemic dropped. And there were particular days where the market went down 7%. And this is when a circuit breaker on the market goes off and trading is halted for 15 minutes. And the other two circuit breakers are at 13 and 20%. And if it gets to 20%, then trading stops for the entire day. And I found these circuit breaker things to be kind of interesting, because this was the first time that I was learning about circuit breakers for the market. And why are they in there in the first place? If people think that these stocks all of a sudden, out of the blue, for no reason, okay, well, it was a deadly pandemic, but for some reason, think that a company is now going to be worth 100% less than it was. The entire market even is worth 20% less than it was the day before. Why are these circuit breakers here? Well, I think that it's there because, as I said earlier, and as I've been saying this entire time, people do not really trade rationally and can be very caught up in their emotions when something like this is happening. It's like everyone, it's kind of like mob mentality. Oh no, like there's a bad thing coming. The markets are going to drop. The markets are going to drop. And because people think that the markets are going to drop, they cause it to drop. People start selling. Everything starts going down, 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 down. And I think that during these times, it's important to just hold your positions and wait for the recovery, because you can't really anticipate these things, right? So hold your positions, wait for recovery. And once you start to feel that the prices are trading at a good discount, then you have an opportunity to buy. And this opportunity to buy is also goes against what the efficient market hypothesis says, because you shouldn't be able to have these kinds of opportunities to buy, because the market is trading off of all the available information. But clearly it is trading off people's fears, off irrationality, and off maybe information that not everybody has, and speculation about what's going to happen in the future. And a lot of us also noticed that tech companies took a hit during this drop as well. But if people thought about it and thought about what was going to happen and realized, now that we can see in the future, because we've been through about 9 months of this thing, people can realize that, hold on a second, why would tech stocks go down in any way, shape, or form? People are going to be stuck at home. Like, those stocks should have gone up so much in value while the rest of the economy was crashing. And in fact, they did go up a lot in value after the fact, after the big crash. And they went up in value after this big crash, and they even surpassed their previous high. But why did they even go down in the first place? If people knew, and if people like collected the information and maybe even just sat around, thought about it for a while, these companies should have just continued to go up. But because some of them are the biggest companies in the market and they're held by almost every investor, if one person sells, then everyone is going to sell. And these companies will take a purely like priced in hit. And, all these lockdowns and all of that did cause a lot of these companies to lose revenues at some point. But a company like Apple that has like $200 billion in the bank, they don't have anything to worry about. They could see like doomsday, they could see the Great Depression part 2, and they would still make it out alive. There is something to be said for markets not trading the way that you would expect to, based off of something like the efficient market hypothesis. Also, in general, while I was listening to Patrick Boyle's interview, I found it quite interesting in how quantitative analysis can remove emotion from a particular trade. So the great thing about quantitative analysis and quantitative trading is that you can kind of remove yourself from the trade and look at it in a purely statistical manner. So you start off with a theory and you test that theory and you continue to see if it, like, what works and what doesn't, and you try to prove your theory. And after you're done running all these tests, you can put it to work, put it into a computer essentially, and make the computer execute the trades for you. And you have your stop loss, you have your like take profit, and you have all of these kind of bounds that you put in specifically for the computer, and it will just execute it exactly the way you tell it to. It won't get attached emotionally to a stock. It won't screw up essentially. Like, it's going to do exactly what you told it to do. And in some ways that's really good, because a lot of people do get emotionally attached to a stock. If they watch it start to go down, they're like, oh, it's going to recover. And the stock just continues to go down and down and down and down, and they end up losing a lot of money. But the quantitative approach is, if you had tested this theory, then you would know that, okay, maybe it's not such a great theory. And if you had this robot in place, it would have sold the stocks well before you had taken a big loss. You'd still have taken a loss, but it would not have been nearly as large. So having those kinds of things in place when you're trading, and the quantitative way of trading I find very fascinating, because I know myself that I am not a great trader when it comes to emotional trading. But if I was to put this into a machine, I feel that I would be able to test this theory and test the probability of it working out, and I would be able to kind of add my stop losses and all of those things and just kind of let it run and see what happens. And I wouldn't really have any attachment to it. Of course, I'd have to put in money that I'm willing to lose, because odds are that I would lose everything. But even still, it would be a much better approach than just throwing money at a stock that I haven't really tested out and just throwing it at the stock for some strange reason, like I believe in the company, right? Those aren't really great reasons to be investing in a company. Sometimes they are. Sometimes people are just like insanely good at picking stocks just because they like a business, which is strange to me, but it does work for some people. I should also explain the 3 different forms of the efficient market hypothesis. So there's weak, semi-strong, and strong. The weak form claims that all past prices of a stock are reflected in today's stock, and therefore any technical analysis of past prices cannot be used to beat the market. Semi-strong goes one step further, that all public information will be calculated into a current stock's share price, and the strong form states that share prices reflect all past prices, public information, and even private information, and therefore nobody can get excess returns. But there are a couple people that are challenging these kinds of theories, and as I've mentioned multiple times, this whole podcast is about it. But one of the challenges to these theories are the small company bias. It's essentially trying to say that smaller companies, that was hurtful. It's essentially trying to say that smaller companies do not follow the exact same set of rules that a bigger company would, for many different reasons. One is that their market capitalization is a lot smaller, so a average investor who has a couple $1,000,000 might actually be able to move the stock price by themselves. And that's one reason. Another reason is that the information on these businesses can change really quickly, and people might not be able to calculate in the information into the share price. Another reason is that these companies are highly speculative, and people tend to expect something of the company in the future that they might not be displaying right now. And there's also there's some other like really interesting market theories. There's something called the January effect out there, which is for small cap companies. And I actually noticed this last year, 2019 December, stocks like dropped, not an insignificant amount, but there was a little bit of fear in the market. And just around Christmas time, everything dumped and then went straight back up. And I noticed that these smaller penny stocks that I had been following throughout university, they actually, like, every penny stock for seemingly no reason at all just increased in price in January. And that was really interesting. And there isn't really, I'm not too sure what the explanation is for the January effect, but it's just a tendency for the market prices to increase in the month of January. So in theory, this small company bias, someone would be able to profit off of the fact that in January, very small companies tend to increase in price. And there are so many other theories out there like this. Like on a Friday, the stock market tends to go up. In the summer months, people tend to trade, like stock prices tend to go up because it's warmer. And in the winter months, stock prices tend to not go up as much because it's colder and people do less trading. So there's so many different things and different ways to kind of phrase market theories and try to exploit inconsistencies in the market. And yeah. All right, everybody. Thank you so much for stopping by for this episode of Footsteps. I really appreciate you joining me today. If you enjoyed this episode, do let me know in the comments below. I know some of the information was a little bit convoluted and I kind of went back and forth, and But I hope that you were able to get something out of it regardless, and I really appreciate you taking the time to listen. And if you liked, please drop me a like and subscribe to the channel on YouTube. Follow on Apple Podcasts, and I will see you guys next time. Bye.